So as a dividend more income focused investor, you want to invest into things like YMAX, the Yield Max Universe Fund of Option Income ETF. And this is because, of course, you want exposure, you want to get into the action when it comes to that distribution rate of around 41%. And how can I blame you? Because a 65 cent, 73 cent, or even 54 cent dividend on a monthly basis for an ETF that costs around $18 per share sounds pretty enticing. But with that massive distribution, you don't want to have as much exposure to the downside that a lot of these ultra high yielders have offered in the past. Well, in this video, we're going to go through a way where you can actually protect some of the downside when it comes to investing into these super ultra high yield ETFs, get paid those massive distributions, but also don't lose money when it comes to these ETFs trading down. Now, if this sounds too good to be true, I promise you it's not. I've done this across my portfolios multiple times, but to be completely honest, I don't see many people talking about this, so make sure to stick around until the end. So if you want to see exactly what my strategy is to protect the downside and to farm massive distributions when it comes to these ultra high yielders, make sure to stick around, drop a like down below, and let's get right into it. Real quick, for those that haven't already, make sure to go to the first link in my description and grab my new dividend investing ebook, where I share exactly how I went from $0 invested to now earning over $6,000 on a monthly basis and over $1 million invested in the markets. Along with the ebook, you're also going to receive my custom dividend tracker, where you can track your dividend progress on an ongoing basis and reach your dividend investing goals. So make sure to grab yourself a copy of my dividend investing ebook and the new dividend tracker today. It's the first link in my description. Now, just to back up for a second, you can do this with different ultra high yielders across the markets. I've done this with TSLY and others, but for this video's sake, let's talk about the YMAX Yield Max Universe Fund of Option Income ETFs, one of the most popular yield max ETFs across their entire basket of products as of right now. Let's use this ETF for this video's sake because this ETF has basically done exactly what I'm talking about. Like I said, this ETF has paid out massive distributions. We're talking 40% yield, 50% distributions, 73 cent distributions for an ETF that costs, like I said, around $20 is madness. But along with that, even if the total return is green, investors have lost some money as far as cost basis goes, as far as on paper, if they bought Yield Max Universe Fund of Option Income ETFs at say around $21 per share, considering as the filming of this video, it's trading at around $18 per share. Now, before you say, well, if you look at total return, actually investors didn't lose anything at all, I totally agree with you, and I totally see that right here. If a Yield Max investor since inception would have just bought into Yield Max $10,000 worth, reinvested those dividends along the way, they would not be red whatsoever. Actually, they'd be up around 14% as far as total return goes and around 26% annualized. Or if they spent the dividends, they would still be up around 13.9% or 26% annualized. So I get it. YMAX actually has been a green investment since inception so far, but I promise you it can get even better. So what I'm talking about here, this strategy is a little bit crazy, but hang in there with me. What I'm talking about right here is I'm talking about selling a covered call on a covered call style ETF like YMAX. So what you're basically going to be doing is buying into YMAX, but also shorting it at the same time. So basically you're owning the shares, you're getting paid distributions, but if YMAX moves down in price, you are actually making more money. Again, I'll repeat this. You're selling covered calls on a covered call ultra high yielder like YMAX. You can do this with TSLY. I've done it with TSLY in the past. And by doing this, you're literally shorting it. So again, you're hoping it moves down in price because you're going to make more money if it does so. Now, for an actual example in real time of how this works, I'll go through the math, etc. So right here, we are on the Robinhood platform. So type in YMAX and then go to trade options. Then of course you could buy a call, you could sell a call, you could sell a put, or you could buy a put. So for this example, click on sell, click on call. Currently YMAX is trading at $18.12 per share. Now again, our goal here is to buy YMAX and earn those distributions, but not lose as much money if YMAX trades down, which again, basically so far, YMAX has a tendency to do that. So once you have the sell and call basically highlighted, you can choose different expiration dates. This is basically how long the option contract is going to last. Now, the furthest expiration date as of right now, when I'm filming this video, is January 17th. It's 169 days away. So basically you're in a contract with the call buyer saying that if something happens on or before the expiration date of January 17th, 2025, they have the right to basically buy your shares at a set price and your shares are going to be at risk of being called away. Now, I'll tell you and I'll explain to you why this is not a big issue and why this is perfectly fine here. Again, our goals here are to buy YMAX, get paid massive distributions, but protect the downside. If that's your goal, if that sounds good to you, then keep listening. So because YMAX is currently trading at $18.12 per share, we have multiple different strike prices to choose from. Now, basically what all these different strike prices are prices that you're going to be willing to sell your shares for. Now on this side, when it says price, these are all the different premiums that you're going to get paid from selling the option contract. So because YMAX is currently $18 per share, if you were to write a contract with the call buyer and say you're willing to sell your 100 shares of YMAX, because option contracts are always in groups of 100. If you were to say, I'll sell you 100 shares of YMAX in the future on or before January 17th, which is 169 days from now, this can happen at any time, then by doing so, by writing that contract, then you have to pay me 63 cents, or 63 times 100 is $63. So because you're doing this, and because YMAX is currently $18.14 per share, this means that in the future, the call buyer is obligated to pay you $18 per share plus 63 cents per share if they want to exercise this contract, which means you would actually make more money in the future than where YMAX is trading as of right now, but you still own the shares, you still control the shares of YMAX in doing so. So you are still going to get paid those juicy distributions along the way. Now, the next thing you're going to have to ask yourself is, during this time frame, during now to expiration date, how much do you think YMAX is going to move down in price? Now, again, this is a video basically assuming that YMAX and a lot of these ultra high yielders are going to continue to move down in price. In the future, maybe YMAX could actually trade at $30 per share. I don't know what's going to happen, but I just know that for the most part, a lot of these ultra high yielders tend to trade down into the right. So that's what we're talking about in this video. But again, anything can of course happen. I'm not saying that YMAX or YieldMax ETFs only trade down. I'm just saying that they have a tendency to do so, at least historically, a lot of times. So let's for a second assume that because right now YMAX is trading at $18.15 per share, let's assume by January it's going to be trading at around $16 or around that area per share. So if you bought 100 shares of YMAX at $18.15 per share, that'd be $1,815 altogether. That's how much you purchased 100 shares of YMAX for. It cost you $18.15. Now, because you bought 100 shares of YMAX, you are of course going to be entitled and going to be earning massive distributions every single month, at least if YMAX keeps paying them like they have in the past. But at the same time, you have a feeling that YMAX is going to slowly trade down into the right. So because of that doing so, you want to write a contract as a call seller with the call buyer saying that you can buy my YMAX shares, my 100 shares for $16 per share from right now up until expiration date. But by doing so, I'm going to charge you $2.53 per share that you buy, or altogether, you're basically going to be earning $18.53 per share. Now again, the call buyer is going to be paying you $16 per share. Now you might be saying, well, what the heck? YMAX is currently $18.14 per share. Why in the world would I sell my shares for $16? Well, if you take into consideration that the call buyer is going to be obligated right off the bat to pay you $2.53 per share on top of the 16, which equals $18.53, that means that you are going to be in the green by a decent margin when it comes to your shares of YMAX. Now that also means that if YMAX doesn't at least move up to $18.53 on or before the expiration date, the call buyer is going to be at a net loss. So you are going to keep your shares for the most part and get paid the distributions along the way. So why is this sometimes the best of both worlds when it comes to these ultra high yielders? Well, like I said, I've done this in the past with TSLY. I bought TSLY at a certain price. I shorted it basically by selling a covered call a few deviations down. I got paid a massive amount of premium for doing so. I got paid the distributions every single month. I also received that premium, and I got to keep my shares because during this time frame, TSLY actually traded down and down and down, which was horrible for the call buyer because again, they're hoping the ETF moves up in price. But because I had a feeling that TSLY was going to continue to trade down, I shorted it and made a lot of money by doing so. Not to mention, I earned the distributions every single month on top of that, because when you sell calls, you are also going to be still holding onto the shares that you bought in the first place. So that's a strategy that I've been using when it comes to these ultra high yielders, because even for me, although I want to earn and have exposure to those massive juicy distributions that names like TSLY, like names like Coney and YMAX of course have offered, I also don't want to necessarily hold on to an ETF that have historically at least continued to trade down into the right. Now you might be asking, well, what the heck happens if you do this thing and of course YMAX or whatever the case might be actually trades up? Well, basically what would happen is that you bought YMAX, like we said, for $18, let's say 10 cents per share. Well, if you sold the cover call at $16 per share, that means you would receive the $16 plus the premium, which is $18.53. So you would actually be up still when it comes down to a net. And basically in between now and expiration, if of course YMAX trades up like crazy, your shares would get called away and the call buyer would be able to purchase your shares once again for $16 plus $2.53 per share, or again $18.53 when you bought YMAX for $18.10. So you would have made $43 in profit off this trade, and basically you'd move on with your life. Of course, you could do this all over again, and you would not necessarily earn distributions, but again, you would make $43 off this trade. So basically, if YMAX from there goes down, you make money. If it goes up, you still make money. It's really an awesome strategy, and that's why I'm such a big fan of selling cover calls in the first place. And of course, you can sell cover calls on normal stocks, other ETFs, but using the cover call strategy on some of these ultra high yielders is sort of a less talked about strategy that, like I said, I've used in the past. It's worked awesome for me over multiple different time periods, and I think it needs to be a strategy that some of you guys definitely need to look into. Now, if these types of strategies are interesting to you, and if you guys want to hear more different, interesting, more less talked about strategies, make sure to like this video and subscribe, because I'm going to be talking and exposing a lot more of these sort of strategies in the future. But now lastly, most importantly, I want to hear from you guys down below. Is a strategy like this interesting enough for you to try it in the future? Let me know why or why not in the comments down below. If you enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.